Most people I meet assume that if their portfolio balance is going up, they must be on track. But here's the catch. Growth alone doesn't mean your investments are actually working towards your goals. I've seen people save diligently for decades, only to discover right when they need income that their strategy wasn't built to last. That's not just frustrating, it can be devastating. In this video, I'm going to walk you through 5 clear warning signs that your portfolio may quietly be steering you off course. We'll talk about risk, concentration, savings, tax efficiency, and why portfolios drift if they're left unattended. Whether you're still building toward retirement or already living off your investments, this will give you a simple checklist to spot problems early. By the end, you'll know exactly what to watch for and what steps can put you back on track before it's too late. If you're new to my channel, welcome. I'm Jacqueline Ozdemir, an advisor here at Ferguson Financial Planning of CI Assante Wealth Management. I work with Canadians who want their money structured in a way that not only grows, but actually supports the life and legacy they're building. Time and again, I've met people who feel confident about their investments until we uncover blind spots that could cost them hundreds of thousands in the long run. That's where I roll up my sleeves, helping bring clarity to complex portfolios and putting simple strategies in place that actually work. And in today's video, I'm going to walk through 5 of the most common warning signs I see in investment portfolios. We'll talk about risk not matching your goals, putting too much in one basket, saving or withdrawing too loosely, ignoring taxes, and forgetting that portfolios drift if you don't realign them. Think of this as a checklist. Catching even one of these early can make a big difference. If you find this video helpful, please hit like and leave a comment below. And don't forget to subscribe and turn on notifications so you never miss what's next. All right, let's dive in. Let's start with the first big red flag, when the level of risk in your portfolio doesn't line up with your actual goals. This might sound straightforward, but I can't tell you how often I meet people whose investments are either far too aggressive for where they are in life or way too cautious to meet the growth they'll eventually need. Here's the thing, if you're in your 30s or 40s and still building toward retirement, you've got time to weather short-term swings in the market. That means growth investments like equities often play a bigger role because you can ride out downturns. On the flip side, if you're approaching retirement or already in it and your portfolio is still set up like you're 25, then you might have a mismatch. Why? Because a sharp market drop just when you're starting to draw income can leave lasting scars. Imagine you've got 80% of your savings in stocks and then the market falls by 20%. It's happened before. That's not a paper loss anymore if you need that money today. Let's look at Shauna, a client case study I've seen before. She was 61 and about 2 years away from leaving her corporate role. Her portfolio still had roughly 80% in equities, not unusual if you've been in a growth mindset for decades, but she had no structured withdrawal plan. If another downturn like the one in 2008 hit, or even around 2021, 2022, her income plans would be thrown off right as she needed portfolio stability. The solution, she shifted to a more balanced allocation, closer to 55% equities with the rest in bonds and income-generating assets. On top of that, she set up a withdrawal plan using a conservative withdrawal rate of only 4%. With this, she knew she could cover her lifestyle assets without selling assets at fire sale prices in a down market. So here's the takeaway. Portfolios shouldn't be static. Just because something worked for you in your 40s doesn't mean it's right at 60. Think of it like upgrading your winter tires. What got you through 10 years ago doesn't hold up now. The key question to ask yourself is this: is my portfolio's risk level realistic for the stage of life I'm in and the goals I have? If the answer is no, it might be time to revisit. Now, let's move to the second warning sign, having too much of your wealth tied up in one place. This could be one stock, one type of asset, or even one industry. And this is something I see all the time with Canadians, especially when it comes to real estate, bank stocks, or employer stock plans. Here's a story. David, a tech executive in his mid-50s, had done really well in his career. His compensation included both salary and stock in the company. Over time, those shares had grown to more than 40% of his entire portfolio. On paper, it looked fantastic. But here's the issue. His investment risk and his career risk were the same. If the company had a bad year or the industry took a hit, David could lose both his job and nearly half of his portfolio value at the same time. That's like building your house on one pillar. It might stand tall until the day that single support gives out. The reality is diversification is less about chasing higher returns and more about not losing the ground you've already gained. A well-diversified portfolio spreads out exposure across industries, geographies, and asset classes. It's not just about owning 10 different stocks either. If they're all Canadian banks, you're essentially still concentrated. A healthier portfolio might include Canadian equities, US equities, international equities, and even some fixed income, plus maybe some alternative investments or private assets. Each one behaves differently, so when one stumbles, another often holds steady or even climbs. David's solution was to slowly reduce his concentrated position. He didn't have to sell everything overnight. That would have come with a major tax bill. But by gradually shifting into global market ETFs and other sectors, he reduced his single stock exposure. The outcome? His portfolio became more resilient. So, when you glance at your own accounts, ask, does any single company, property, or sector make up more than 20% of my portfolio? If the answer is yes, you might be leaning too heavily on that single pillar. The risk is that if it falls, it could significantly impact your financial future. All right, the third red flag, not saving or withdrawing in a way that matches your future needs. This one hits on both sides of the equation. On the saving side, even the best portfolio can't make up for contributions that don't add up. A common rule of thumb in Canada is saving at least 15 to 20% of your pre-tax income during your working years. That's the fuel your portfolio needs to actually grow into something that can sustain you. Think of it this way. If you only put in 5%, you're asking your investment returns to do the heavy lifting of generating the other 15%. That's a tall ask. On the withdrawal side, I meet a lot of people who underestimate just how quickly money can drain if the withdrawal plan is too aggressive. A sustainable rate in Canada has often been pegged at around 3.5% to 4%. Let's put real numbers to that. Say you retire with $2 million invested. At a 4% withdrawal rate, you'd be drawing $80,000 a year. That's before tax, but it's also at a level most portfolios can keep up with through growth and income over decades. If you bump that to 6% because you want $120,000 a year, that math shifts fast. Over a 25-year retirement, those withdrawals could completely erode principal long before you're ready. Take Ravi and Priya, for example. Both business owners in their late 40s. Their portfolio was spread across an RRSP and a corporate account, but weighted heavily in bonds. Their savings were consistent, which was great, but here's the problem. The after-tax returns on those bonds weren't keeping up with the lifestyle they wanted later. Drawing too much too soon would have left a gap down the road. By shifting some of the bonds into their RSP and reallocating growth assets into the corporate account, they not only boosted efficiency, they actually gave themselves more confidence that their portfolio could support the withdrawal needs they had projected. Here's the practical test. Ask yourself whether your savings rate now is truly high enough to build financial security and whether your future withdrawal assumptions are realistic. If either side of that equation is off, even a strong portfolio could end up failing the lifestyle test. The fourth warning sign is one I see way too often, ignoring how taxes affect your investment returns. We love to focus on rates of return, but what matters more is what you actually keep after tax. Different types of income are taxed differently in Canada, and where you hold those investments makes a huge difference. Interest income, like what you earn from bonds or GICs, is taxed at your full marginal tax rate. For someone earning in the top bracket on Ontario, that can be more than 53%. Dividends from Canadian companies benefit from the dividend tax credit, so they're taxed a bit more gently. And capital gains, the profit you make when selling an investment at a higher price, are only half taxable. Right away, you can see how the same dollar earned can have a dramatically different net result depending on where it comes from. Here's the kicker. You can tilt things in your favor simply by placing investments in the right account. Think of RRSPs, TFSAs, and non-registered accounts as baskets. Each basket has its own set of tax rules. Interest-bearing assets do better inside RRSPs or TFSAs since you're sheltering that income. Meanwhile, growth-oriented investments like equities can sometimes be better in a taxable account because they benefit from the lower tax rate on capital gains. Let me paint the picture with Ravi and Priya again. Their portfolio was bond heavy, but most of those bonds sat in a corporate account. That meant all that interest income was being taxed quite heavily, cutting deep into their after-tax returns. In addition, this interest income was eroding their small business deduction on their active business income in the corporation. By moving the bonds into the RSP, they sheltered the interest from immediate tax. At the same time, shifting equities into the corporate account meant future gains would be taxed at a lighter rate, and they were able to preserve their small business deduction. This strategy works well if we were comparing an RRSP and a non-registered account as well, outside of a corporation. Overall, though, this small change improved their long-term net returns without them having to take on one more ounce of risk. So if you're scratching your head at why your portfolio's performance doesn't seem to match the markets, the answer could actually be taxes. Shuffling which investments sit in which basket can often put thousands of dollars back into your pocket over time, money you'd otherwise be handing off to the CRA. And that's not nothing. No rebalancing or strategic adjustments. And finally, the fifth warning sign, forgetting to rebalance or adjust your portfolio over time. Investments are like a garden. You set the beds up, but if you never prune or replant, things get overgrown in ways you didn't plan. A portfolio might start with a nice clean split, but markets move. Say you set up a 60-40 portfolio, 60% equities, 40% bonds. If equities rally hard for a couple of years, suddenly you're sitting at a 75% equities and maybe only 25% bonds. The risk is that's no longer the portfolio you thought you had, inadvertently taken on far more exposure to market volatility than you initially signed up for. And this isn't just theory. Let's look at the last decade. Tech stocks exploded in growth. Plenty of investors who had broad exposure in 2010 or 2011 looked up by 2025 and found that a huge portion of their portfolio had become tech heavy. The danger here is that when a tech correction hit, they felt far more swings than they thought they bargained for. Take David again, our tech executive. His situation wasn't just about being overweight in his employer's stock, it was also that his whole portfolio hadn't been rebalanced in years. Certain sectors had ballooned while others had shrunk. By reviewing annually and trimming back the overweight positions, he could have avoided a lot of those concentration risks. Rebalancing doesn't have to be complicated. Once a year or when there's a big life change, like retirement, selling a business, or receiving an inheritance, take a look at the actual percentages in your portfolio compared to your original plan. If one area has drifted too far off, trim it back and top up the other. It's like realigning the wheels on your car. You might notice when they're slightly off, but left unchecked, you'll wear down the tires unevenly. The key takeaway here is simple. Portfolios drift, and if you're not checking and adjusting regularly, you may be taking on risks you didn't intend to take. So those are the 5 big warning signs. Risk that doesn't match your goals, concentration in one asset or sector, shaky savings or withdrawal practices, ignoring taxes, and forgetting to rebalance. Catch 2 or more of these in your portfolio, and it's probably time to give things a thorough review. Remember, it's not about obsessing over every detail. It's about making sure your portfolio is working for you, not against you. Because at the end of the day, a portfolio isn't truly successful just because it grows. It's successful if it grows towards your goals, supports your life in the way you actually live, and keeps risks in check so you can feel confident along the way. The big implication here is simple. Wealth isn't just grown, it's managed. Shauna avoided a retirement crunch by shifting risk before it was too late. David reduced concentration and tax drag, setting up more stability. Rabi and Priya improved efficiency without adding risk. Those adjustments didn't require a crystal ball, just the discipline to step back, assess, and realign. If you ignore these warning signs, you're leaving your future to chance. But if you catch and correct them, you're not only protecting your money, you're making sure it actually supports the life you've been building. That's the part that really matters. So here's where I'll leave you. If you spotted 1 or maybe even 2 of those warning signs in your own portfolio, that's not a reason to panic. It's just a signal that it could be time to step back and take a closer look. And honestly, most people don't realize what they're missing until they see the numbers laid out. I'd love to hear from you. What's the biggest question you still have about structuring your portfolio the right way? Drop it in the comments and I might cover it in a future video. And if you'd like to take this a step further and see how these adjustments could apply to your own situation, use the link in the description to book a call with me. We'll go through it together and figure out if your portfolio is really working for you or against you. Also, if you found this helpful, make sure you hit subscribe and turn on notifications so you don't miss the next video. Thanks for watching, and I'll see you in the next one.